Hello, happy Sunday, and I can't help myself. I want to talk about interest rates again. I know we are all hopeful and giddy that rates are going to come down, and I know that rates improved by a few basis points last week, and I know we now have full expectations. I want to give it 100%. I still say it's closer to 50-50 that the Fed's going to cut interest rates by a quarter point in the September meeting. And there's possibly a chance they cut it by 50 basis points. So I know that. And I know that that the president is nominating a dove to the Treasury that will be the third voice, certainly on the side of cutting rates, and that he's emasculated Chairman Powell. I know all that. I know all that. But I am telling you, I am cautioning you, there is still a lot of upward pressure on the long end of the curve. And if we're going to give good advice to our clients, I think we need to start with interest rates might be as good as they get. That's where we need to start. Now, with that, what we have to do is we have to lock and load. We have to make sure we have all our borrowers fully apt and approved, especially our refi borrowers, and that we have a targeted strike price for what rate they need to have a successful refinance. Because in the last boomlet, Brian Hale came up with that name, last boomlet, last September, only 10% of the refi apps closed because the preponderance of them wasn't locked and the market only was fleetingly down to where it would have made sense, and those borrowers weren't protected. Whether the borrowers were greedy, hoping for a lower rate, or the loan officers were giving them bad advice, they missed out on the opportunity. What I would recommend is lock and load, especially refi clients, know what rate makes sense. Now, if I'm wrong, if you're wrong, and rates continue to improve, you can renegotiate while you're in process. If rates can improve after you're done, you can do a no-cost refinance, right? But the insurance policy is to make sure you lock in and protect your clients. Now, let me tell you why I think rates have upward pressure. And I know I talked about this last week, and I know I talked about it a week before. But each time I've talked about it, I've used a different economist or a different viewpoint. Last week, about a week ago, I talked about what the upward pressure is on interest rates. I used a Fed study that every 1% of debt to GDP puts 3 basis points on interest rates. There was 5 studies to support that. GDP to debt is expected to go up by 20% in the next 10 years. That's 60 basis points. That's a problem. That's a huge problem. But this week, you know what I'm going to do? I'm going to rely on a article in Bloomberg News, and it was also written by 3 economists about why there is a ton of pressure on interest rates, on long-term interest rates. And by the way, I know we're giddy about all those things we talked about, but if you noticed, the 20-year and 30-year auctions last year went horribly. As a matter of fact, analysts labeled the 30-year auction ugly, and it's very likely that the government's going to quit selling the long end of the curve. And in fact, right now, very fascinating, the government's going to switch to short-term T-bills. It's a very aggressive policy, but in order to minimize the cost of borrowing on the U.S. government, they're switching to the front end of the curve. And I read a credible article that said the Fed is going to possibly start selling off, not just waiting the runoff, but selling off the long end of the curve so that they can now start buying up to $3 trillion in T-bills. And T-bills mature in 60 days to 12 months. They're very, very short. And you issue them, super low interest rate, you roll them over, you roll them over, you roll them over. But what will happen, that means the Fed will be buying the short end of the curve, suppressing rates on the short end of the curve, and leaving the long end of the curve to become unmoored or even have a greater difference between short end and rates. But let's look at the Bloomberg article. I'm going to share some charts in just a minute, but here's their arguments. They said, okay, look, here's the deal. We all lived in a period where interest rates improved for 3 decades. Like that's what we know. Now, did it go straight down? No, but it's kind of like this. But for 30 years, if you're a loan officer today or a real estate agent, unless you're older than I am, the only thing you can remember is interest rates improving. That's the only thing you can remember. Matter of fact, when I got into the business, 1999, I was making hay, refinancing people out of 13.5 interest rate FHA loans into 8.5 interest, and it was a boom period. But so we've had 30 years of all sorts of factors that supported lower rates. For example, boomers were giant savers. They were giant savers, and they were buying a ton of bonds, right? And so what that is, that increases demand, right? When you increase demand, prices go down. When you increase supply, prices go up. So baby boomers were eating a ton of supply, creating demand. Foreign nations like China and Saudi Arabia were investing heavily in U.S. debt. Now, China, they had such a huge trade imbalance. The only way they could control their currency was take that imbalance and buy back into treasuries. That's the only thing they could do. Saudi Arabia, same thing with their oil, huge trade imbalance, had no choice but to buy back into treasuries, the world currency, right? They had to try to buy back into it. That's not true today, and I'm going to explain why in a minute. But that created a giant demand, right, which put downward pressure on price. The next thing that we had that for those 30 years is we had a very trustworthy Fed with a very, very, very strong anti-inflation reputation. After the 70s, the Fed just became absolute inflation hawks and would do anything to avoid inflation. Today, that reputation is crumbling, right? And not just because the president is beating the hell out of the Fed to make them cut rates. Every president does that. Every president, but the thing is, now we're feathering the Fed with doves that want to lower interest rates, and if they lower interest rates into the teeth of inflation and we get stagflation, which we're absolutely headed to, it's going to really break the trust in the Fed, which is a huge problem. And then, of course, if you go back to, say, 2001, where GDP was 30%, or debt was 30% of GDP, today it's nearly 100%. The other thing, you guys may not believe this, but in 2001, we had a budget surplus. So we had a budget surplus where today we have massive amounts of debt. And we have to issue trillions of dollars of new debt every year. And what we're doing? We're flooding supply. But back then, when we had very little debt, there wasn't a lot of supply, which really boosted demand, right? And so all those things created this 30 years of just structurally driving down rates. Now, let's look at those same forces today. Today, boomers are retiring, and you know what? They're not investing. They're starting to liquidate their debt. So if they had in their portfolio, they had bonds, stocks and bonds, well, they're starting to liquidate those things as they're in retirement. They're liquidating. So they're selling off that asset. They're creating more supply, not creating more demand. Right? I'm going to show you a chart in a minute. China has been reducing their U.S. Treasury holdings because they no longer they've floated their currency, or they've removed their currency controls, and they're not worried about becoming untethered to the U.S. dollar, and so they don't need to buy U.S. Treasuries. And then on top of it, they have political purposes that not support it. Same thing with Saudi Arabia. Saudi Arabia now is not worried about tying themselves to the U.S. dollar. And in fact, they're taking that money and they're making trillions of dollars of infrastructure investment in their own country, and that's where those dollars are going today. And then, as I talked about, the U.S. debt now is 100% of GDP, and we're issuing just, as the Wolf Street says, a Mississippi River full of debt. Where we are just crushing the supply without the related demand. And then, of course, we're starting to get distrust of the Fed and U.S. financial stability, which is a problem. And I will add something else, which is an interesting thing, is that other countries are now starting to issue debt that didn't issue debt before. The fact that we're rightfully forcing other countries to dedicate 3.5% of their GDP to military, countries that have never done that, countries like Germany, and now Germany and France are having to issue a ton of debt. And to some people, that debt looks more attractive than U.S. debt, and it gives them an alternative. And so we're losing demand to these other countries now that are issuing their own debt, which is also a problem. So all those are the headwinds that are causing reduction in demand, and while we have an abundance of supply. So structurally, this Bloomberg article argues, look, there's only one way for interest rates to go, and that is up. Long-term interest rates can only go up. Now, can we have a world war that changes that? Can we have some sort of calamity, a COVID-12? Absolutely. Can the Fed start buying the long end of the curve? They could. They're not going to. Matter Scott Bessent said he was going to do that before he was nominated, but then debt's so out of control, they can't afford the cost of going long-term debt. And so that's why they're pivoting hard, doing something we haven't done before, funding a ton of our debt in T-bills. We've always funded a small percentage, but not 20, 30%, which is incredible. So, you may not agree with me. I know I'm telling you something you don't read anywhere else. I know I'm not aligning with the industry sycophants and the echo chamber that's just telling you lower rates are coming and we're, margins are too high, all this stuff. I don't think so. Everything I keep reading, everything I keep sharing you every week, another Fed, another economist paper, another Fed, another scholar. Here's why there's upward pressure, and we're seeing it in the market. The long end of the curve is not behaving, and it's threatening to become untethered from the Fed, where the Fed can't control it. And if at all the bomb vigilantes start to think the Fed is irresponsible, if foreign governments, people investing in bonds think the government is irresponsible, they will punish the government. They will punish the price. It's already super borderline, and you may or may not believe it. Just when you give advice to your clients, just double check what you're saying. Do not, sell Pollyanna. Be realistic, because we can only give our customers bad advice so many times before they quit trusting us and quit using us. And we certainly have given them bad advice. I'm not getting my soapbox here. In the past 3 years, where we said date the rate, marry the house, or we sold them a 2-1 buy down, promised them rates would be better in 2 years, and that they could automatically lower the rate. I sold my rule on that. I'm telling you, there's upward pressure on rates. So I'm going to share this article. You're going to want to see it, so stick with me. Here's the article, by the way. This is the Bloomberg article. As you can see, it's by Jamie Rush, Tom Orlik, and Stephanie Flanders. All right. And the first chart I want you to pay attention to is this one right here called demographic density. And the black line is, what this is boomers' savings. So boomers were saving up until, about 2010, and now they're net sellers. They're net sellers. So the amount of treasuries they hold, they're now selling, which is a problem, right? They're selling. There's no longer have the demand, and now they're adding supply. Problem number one. Problem number two, as I mentioned, in 2001, debt was 30% of GDP. That really created a lack of supply. There wasn't a lot of supply of new debt, right? It was highly manageable. Matter of fact, in 2001, we had a debt surplus, so we weren't selling $2 trillion a year in debt, right? That was creating this massive supply. But look, today, we're almost at 100% debt to GDP, and that's going to go to 120% in the next 10 years. We are going to sell trillions and trillions of dollars of new debt, right? Of new debt, and we don't have the buyers for it. We don't have the demand. And if the Fed loses their integrity, it's going to cost us a ton to get people to buy that debt, which is fine. Once again, we just need to be great advisors around this concept. We can't just bury our head and listen to the industry echo chambers about Pollyannish rates are going down, rates are going down. I think we need to be better informed than that. Let's go to the next chart right here. This is China not buying. You can see China peaked around 2015 right here. They had 2014. They had $3.8 trillion in U.S. debt. Today they're down to 3.3. They've sold $500 billion run off, and the trend is they're probably going to keep doing that. So they're no longer a buyer. Now they're a seller. Now they have minimum buys because they're buying back some of the runoff, just like the Fed does. They have to kind of manage their overall inventory, but they're net sellers, right? What is that? Less demand. What else? more supply. It's a big deal. And the curve for Saudi Arabia is much steeper, much steeper, right? And so as you start looking at, and then the next thing I just want to share, the next the concept I want to share is what's called the natural interest rate. You might know it as the neutral or the R star. And I want to finish with that. I want to finish talking about the natural or the neutral or the R star. And if I know I just briefly showed you this chart, but at one point, the R star, that is where interest rates are not, they're not tightening and they're not accommodating. They're neutral. They're neutral to the economy. They're not stimulative and they're not restrictive. Super to understand. Back in like 2018, the R star or the neutral rate was at 1.7%. 1.7%. Right now, it's at 2.5%. 2.5, right? So that's significantly different. That's what economists think we're at. That's the neutral rate, right? And by the way, a 2.5% neutral rate translates into a 4.5% 10-year treasury. Now, what economists think is that we're going to get to 2.8 by 2030, which is going to get us to a 5%, a 5% 10-year treasury. And in fact, if you read this article, and I'm going to put a link to the article in my notes below, you should be able to access it. It's behind a paywall. Depending on how many Bloomberg articles you tried to ping in the last month, you may or may not get access to it. If you don't get access to it and you want a copy, ping me in the DMs. I will send you a copy, okay? I'll gift you a copy, so ping me back. But what the article says and what economists think is that we may have to, the neutral rate may have to go above 3%. And what they're arguing is that we may have to have a 6% treasury, right? 10-year treasury. That may be structurally the R star or neutral rate going forward. But certainly 2.5 is definitely that's 4.5% 10-year treasury. 5% is looking right at us in the windshield. That's going to, or 2.8%, which is giving us a 5% 10-year treasury. I just want you to be aware of this. There is a massive upward pressure on long-term rates. And what I hope is that you can be open to the concept so that we can give better advice. And if we're wrong, I'd rather be wrong saying rates are going to stay too high and get people locked in as quickly as it benefits them and then deal with a renegotiation or a refinance the road than not give good advice or firm enough advice and let them miss out on an opportunity to save a ton of money. Because here's what we're seeing. We're seeing a dip right now, and I would not be surprised to see rates dip again. I wouldn't be surprised if rates dip, depending on where you're at, somewhere between 6.25 and 6.5. And I'm telling you, if you have anybody in your database that can benefit from that rate, lock them as soon as the rate shows up, because it's going to be fleeting. I promise you, it's going to be fleeting. And if I'm wrong, renegotiate. If I'm wrong, well, good for you. You get another refinance down the road. All good. But if I'm right and you don't protect your clients, you haven't done a good job, in my opinion. So now, here's the deal. We talked. I'll check. I'm gonna put a link to this right before you can. Also, I already have a link to it on. I did a lengthy LinkedIn post on this today. You can get a link to the article there. Like I say, you can ping me wherever you want. I'll send you the copy of the article if you want it. But just be aware. Last week I talked about these economist papers, the Fed, right? I talked about all these economist papers about 1% of debt to GDP adds 3 basis points. I cited 5 studies. Today I'm citing this economist paper from Bloomberg. I've cited tons of people in this. As a matter of fact, I wrote an article last January, and I asked the question, and I posted this article on LinkedIn. Go back and look at it. The name of the article, title of the article is what if interest rates are as good as they get? And I cited something like 12 economists that argued why there was upward pressure on interest rates. And that has pretty much, by the way, that philosophy has pretty much stood the test of time this year. And at the time, not that I'm thin-skinned, I got a lot of criticism about that position. Even though I was quoting a dozen world-class economists, those economists have been largely right. I mean, we've had a little bit of softening, but we're not having a lot of softening. I hope this helps. I hope you like information like this. I hope you use information like this, because we can't be trusted advisors if our advice sucks. And sometimes we have to step out of the echo chamber to get better advice, just to be a little more broadly minded. And then we have to help manage risk reward for our clients. And if we're wrong, let's do it on preventing the risk and helping more reward. Anyway, I hope you had a great week. I know it's Sunday. I hope you're probably watching this next week, during the week. I hope you got something out of this. Check out my socials. Try to get this article. I've talked about interest rates quite a few times. Check out my article from January. See if it holds true today. I mean, it's 8 months ago. I'm proud of that article. I did a lot of research on that article, and I think it's held up. Check that out. But please, consider what I'm saying. Consider putting it into your advice. I know I went a little long again today, but I appreciate you giving me your attention. I hope you're having a great day. I hope you're off to a great week. I look forward to talking to you again soon. Thanks so much.